Credit cards are one of the most popular financial tools available today. They allow people to make purchases and pay for them over time, with interest. The annual percentage rate, APR, is a key component of credit card interest rates. It is important to understand the different kinds of APRs and how they affect credit cards in order to make informed decisions about using credit cards. APR stands for annual percentage rate. It is the cost of borrowing money over a year, including interest and fees. APR is used to calculate the interest rate you will pay on your credit card or loan. APR can vary depending on the type of credit card you have and your creditworthiness. There are several types of APR, each with its own features and impact on credit cards. Types of APR. There are several different types of APRs that can apply to credit cards. These include 1. Purchase APR. Purchase APR is the interest rate charged on the purchases you make with your credit card. It is the most common type of APR and typically ranges from 10% to 25%. This means that if you carry a balance on your credit card, you will pay interest on your purchases at this rate. 2. Balance transfer APR. A balance transfer APR is a special interest rate that is offered when a consumer transfers a balance from one credit card to another. Balance transfer APRs are usually lower than the standard APRs for purchases or cash advances, and may even be 0% for a limited time. Balance transfer APRs can be a good way for consumers to consolidate their credit card debt onto one card with a lower interest rate, but it's important to read the fine print, as balance transfer fees may apply. 3. Cash advance APR. A cash advance APR is the interest rate charged when a consumer uses their credit card to withdraw cash from an ATM or bank. Cash advance APRs are typically higher than the APRs for purchases or balance transfers, and interest starts accruing immediately, with no grace period. Cash advances should be avoided whenever possible, as they are an expensive way to borrow money. 4. Penalty APR. A penalty APR is a higher interest rate that is applied when a consumer misses a payment or makes a late payment. Penalty APRs can be as high as 30%, and can be charged indefinitely, even if the cardholder brings their account up to date. Penalty APRs can make credit card debt much more expensive, and can be difficult to get rid of once they are applied. 5. Introductory APR. An introductory APR is a promotional interest rate that is offered for a limited time, usually 6 to 18 months, when a consumer opens a new credit card account. Introductory APRs can be as low as 0%, meaning that cardholders do not have to pay any interest on their balance during the promotional period. After the promotional period ends, however, the APR will revert to the card's standard rate, which may be significantly higher. Introductory APRs can be a good way for consumers to save money on interest charges if they plan to pay off the balance before the promotional period ends. 6. Variable APR. A variable APR is an interest rate that can change over time, based on a variety of factors. Variable APRs are usually tied to a benchmark interest rate, such as the prime rate, and can increase or decrease as that benchmark rate changes. Credit card issuers are required to notify cardholders in advance of any changes to their variable APRs. Variable APRs can be attractive to consumers because they may start out lower than fixed APRs, but they also carry more risk, as the interest rate can rise over time. 7. Fixed APR. A fixed APR is an interest rate that stays the same for the life of the credit card. This means that if you have a credit card with a fixed APR of 15%, your interest rate will always be 15%, regardless of any changes in the market or the credit card issuer's policies. Fixed APRs are typically offered to cardholders with good credit, as they are seen as less risky borrowers. Now let's see how APR affects credit cards. APR can have a significant impact on your credit card. The higher the APR, the more you will pay in interest charges. This can make it more difficult to pay off your credit card balance, as more of your payment will go toward interest and less toward the principal. For example, if you have a $1,000 balance on your credit card with a 20% APR, you will pay $200 in interest charges over the course of a year. If your April is 10%, you will pay only $100 in interest charges. The April can have a significant impact on credit cards in several ways, including interest charges. The higher the April, the more interest you will pay on your credit card balance. This means that if you carry a balance on your credit card, a higher April will result in more interest charges, making it more expensive to carry a balance. Minimum payments. The higher the April, the higher the minimum payment required to pay off the balance over time. This can make it more difficult to pay off the balance, as a larger portion of your payment will go toward interest charges rather than the principal. Balance transfers. April can also affect balance transfers. If you transfer a balance to a credit card with a lower April, you may be able to save money on interest charges. However, balance transfer fees and promotional APRs can also affect the overall cost of the transfer. Credit score. High APRs can also have an impact on your credit score. If you carry a balance and make late payments, your credit score can be negatively affected, making it more difficult to get approved for credit in the future. In the end, conclusion is April is an important factor to consider when choosing a credit card. It can have a significant impact on your finances and your credit score. Understanding the different types of April and how they affect your credit card can help you make informed decisions about your finances. It is important to shop around and find a card that meets all your requirements. Good luck, and I hope this helped you in understanding April and their relation to credit cards.